Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets that usually put you to sleep. But trust me, this report has some juicy bits that will keep you awake and maybe even make you a little richer if you know what to watch out for. Today we're diving deep into the latest filings for Fidelity Advisor Series I-5 for the period ending the 30th of November 2025. Now this isn't just some dry document about a fund group, it's a window into how your money is being managed and where it's going. Let's get straight to the numbers. This fund is substantial with over $167 million under management as of the 30th of November 2025. That tells you it's a significant player in its market. So what are they doing with all that cash? Well, the report breaks down their investments pretty clearly. A huge chunk, almost 76.4% of the fund's assets are sitting in US Treasury obligations. Think of these as government bonds basically lending money to the US government. It's generally considered a safe bet and a way to preserve capital. Drilling down further into those Treasury obligations, about 75.7% of it is in US Treasury notes. These are typically medium-term bonds, so not super long-term, not super short-term. This tells us they are aiming for a balance between yield and interest rate risk. Next up at 13.8% we have CMOs and other mortgage-related securities. Now this sounds complicated, but basically these are bundles of mortgages that are sliced up and sold. They can offer a good return, but they also carry more risk than plain treasury bonds. Looking at the actual holdings, these are some of the specific investments made. For instance, under collateralized mortgage obligations, we see things like Fannie Mae Guaranteed Remix Series 2002 to 75 Class FA with a value of over $3 million. These are complex instruments and represent a significant portion of this category. Now this part gets interesting. The fund is actively using derivatives like swaps and futures contracts. In the schedule of investments we see a section on interest rate swaps with values like negative $75,632. This indicates they've entered into contracts where they might owe money based on interest rate movements. When we look at the statement of assets and liabilities, we see the impact. Under liabilities, we have payable for daily variation margin on futures contracts at $34,648. This means they have an obligation to pay out that amount based on the current market value of their futures positions. On the flip side, it shows they have receivable for daily variation margin on centrally cleared swaps at $8,909. They are owed that amount. It shows they are actively managing their exposure to interest rate changes using these tools. The statement of operations really shows the performance. For the year ended the 30th of November 2025, the fund had net investment income of over $6.5 million. This is the money they earned from their investments after accounting for expenses. But the real action is in the gains and losses. They reported a net realized gain of over $1 million from selling investments and futures contracts. On top of that, they saw a change in net unrealized appreciation of over $1.5 million. This means the value of their holdings went up on paper. Overall, the net increase in net assets from operations was over $9 million. This is a healthy, positive result for the year. Now let's look at the per S-hair data in the financial highlights. The net asset value per S-hair ended at $9.79. That sounds simple enough, but what if we think about what that means in terms of investment growth? The total return for the past year was 5.36%. This means if you had invested $10,000, you would have made about $536. That's a respectable return in the current market environment. Looking back over 5 years, the return was 0.91% and over 10 years it was 1.42%. Those longer term numbers are a bit more modest, and that's something to consider when thinking about long-term investment goals. Comparing this to the benchmarks, we see it performed pretty similarly to the Bloomberg US 1 to 5 year government bond index, which had a 1-year return of 5.51%. It trailed slightly, but not by much. This indicates the fund is pretty much tracking its benchmark closely, which can be a good thing if you want steady, predictable returns, but perhaps not if you are looking for the fund to significantly outperform the market. And to give us confidence in these numbers, we have the report of independent registered public accounting firm. They state that the financial statements present fairly in all material respects the financial position of the fund. This is the auditor giving their stamp of approval, saying everything looks good and follows generally accepted accounting principles. It's crucial for transparency and investor confidence. Now, here is something interesting that often gets overlooked: the board approval of investment advisory contracts and management fees. This section talks about how the Board of Trustees reviewed and renewed the contract with Fidelity Management, Amp Research Company LLC. They considered the nature, extent, and quality of services provided, the competitiveness of fees, and the profitability of Fidelity. They concluded that the advisory fees were fair and reasonable. This is essentially the oversight mechanism ensuring that the fund managers are doing a good job and not overcharging. They looked closely at where the money was going and what services were being provided. This included the investment strategy, the staffing, the resources, and even shareholder services. It's a thorough review to make sure Fidelity is earning its keep. The report shows data comparing the fund's management fee and total expense ratio to similar funds. It indicates that Fidelity's management fee rate ranked below the competitive median for similar funds. This is good news for investors because it means they're not paying an overly high fee for the services provided. The total expense ratio was also below the median, which is also a positive sign. They also assessed Fidelity's profitability from managing this fund. They concluded that the profitability was not excessive, which is an important check on fees. And they considered economies of scale to ensure that as the fund grows, any cost savings are passed on to shareholders. So what is my take on all of this? The Fidelity Limited Term Government Fund appears to be a well-managed, relatively conservative investment. They are heavily invested in US Treasury and mortgage-related securities, which generally means a focus on stability and income generation. The use of derivatives suggests they are actively managing interest rate risk, which is a smart move in today's market. The past year showed solid returns, and the fund seems to be performing in line with its benchmark. The renewal of the advisory contract with a thorough review of fees and services indicates a commitment to investor interests. However, the more modest returns over the longer 5 and 10-year periods suggest this fund might be more of a capital preservation play rather than a growth engine. If you are looking for aggressive growth, this might not be the fund for you, but if you prioritize stability and a managed approach to investment risk, it certainly fits the bill. The key takeaway is that Fidelity seems to be diligently managing assets and fees for its investors. Alright, that's our deep dive into this filing. What do you think about these numbers and what they signal for the fund and its investors? Let us know in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more corporate insights. Also, don't forget to join our Discord community linked in the description for more discussions. Thanks for watching. See you next time.